Exercise 1114 asks us to do three specific things from a set of information based on the direct method of cash flows. They ask us to compute cash received from customers, cash paid to suppliers, and cash paid for income taxes. I'm going to do these both the book way and my down and dirty common sense way. You pick whichever way makes the most sense to you. So they tell us the net sales is $3,200,000. We look at it and we see that accounts receivable increased by $55,000. So if accounts receivable increased by $55,000, we have taken credit for $55,000 worth of sales for which we did not collect the cash. So we subtract that $55,000, and cash received from customers $3,145,000. Now, my I ain't too bright method says, okay, I'm going to start with net sales, $3,200,000. I know, or I'm going to act as if I collected all of my beginning accounts receivable. And they tell me my beginning accounts receivable was $230,000. I also know that I did not collect my ending accounts receivable. By definition, that's what that is. That's the accounts receivable we didn't collect at the end of the year, and that's $285,000. So I did not collect that cash, and when I do that, I find that my cash received from customers is $3,145,000. You pick the method that fits best in your head. That's the best method to use. The next, they ask us to do cost of goods sold. So cost of goods sold is $2 million. They tell us that. As we look at the balance sheet data, we find that our inventory had been $40,000. Our inventory total decreased by $40,000. So if inventory decreases in $40,000, our cash flow has to increase by $40,000. So the decrease in inventory reduces our cost of goods sold. So we'll subtract that because our cost of goods sold includes a decrease in inventory. And that kind of makes you think a little backwards. But altogether, that gives us the purchases of $1,960,000. I think this problem, you'll see that my I ain't that bright method works a whole lot better. Now, our accounts payable went up $17,000. Okay. Now, since we're looking at a cost, again, we have to take a look at our accounts payable. It decreased by $17,000, so we have to again add that because our accounts payable went up. We didn't pay that. So that's $1,977,000. You just have to think what side you're looking at and who are you doing the accounting for. Now let's take a look at my down and dirty I ain't that bright method, and I think you'll find in this case it's easier. We have $2 million in cost of goods sold. Now that cost of goods sold includes our beginning inventory and our ending inventory. Our beginning inventory we paid for last year. So we're going to subtract the beginning inventory because we paid for that the year before. And if we take a look, our beginning inventory was 165. So we subtract that. But our ending inventory we paid for this year, but we're going to report that on the cost of goods sold next year. So we include that. So we add our ending inventory, and in this case the ending inventory is 125. So if you take the 165, subtract 2 million, subtract 165, add 125, you come up with 1,960,000. So you're going to come up with the same answer. It's just that this method makes more sense to me. It fits into my head better because I can look at it and say, when did we pay for this? Did we pay for this year? Did we pay for this last year? If we paid for this year, it gets included. If we paid for this last year, it gets excluded. Beginning inventory we paid last year gets excluded. Ending inventory we paid for this year gets included. Now we have accounts payable. And that works the same way. We assumed that we had to pay all of our beginning accounts payable or people would not have sent us money. So we're going to add that because remember this is a cost here. So we're going to add the 137,000. That's our beginning accounts payable. And we're going to subtract our ending accounts payable. I wrote receivable, I meant payable. Because we're not going to pay our ending accounts payable until next year. So we subtract that. That's our ending accounts payable. And if you take the 1,960,000, add 137, subtract 120, you indeed come up with 1,977,000. Again, they're the same method, it's just a different way of looking at it. And last but not least is income tax expense. And they tell us that our income tax expense for the year was $150,000. And one of the things you're going to learn that in business you don't have to pay all of your taxes every year. Sometimes you can carry them forward, sometimes you can carry them backwards. It's not all that odd in business. You and I are people, we're used to April 15, send them a check. Now our income tax payable went up. So our payable went up. So we did not pay $9,000, the increase in our accounts payable, our tax payable, for income tax expense. So that's $141,000 is cash paid for income taxes. Now again, we can do that using my I ain't that bright method. Take our beginning income tax expense, of $150,000. Using the same logic, we paid all of the beginning tax payable. And our beginning income tax payable was $16,000. So we add that, and we didn't pay our ending tax payable. That would be the very definition of tax payable. What we did not pay, and we did not pay 25. So we take our tax expense, increase it by beginning tax payable, decrease it by ending tax payable, and we paid 141,000 for income tax. It's the same method. It's the same exact number. It's just a little easier way to think about it, in my opinion.